For this next video lecture, so we will be focusing on the working capital and investment financing policies, but these are just some sort of overviews, okay, of this topic. For financial analysis, working capital is equal to current assets. So this is how we define it, or the term working capital. For accountants, working capital means current assets minus current liabilities. For the administration and control of the company's working capital, so this is called as working capital management. Okay, so the primary objective of this is to achieve a balance between the return or profitability and the risk. Okay, so because we are talking about investment financing. So if there is investment, so basically we are managing the risk and return. Okay, so current assets are reasonably expected to be realized in cash or consumed or sold during the normal operating cycle. So if you could still remember in your discussion in the basic accounting, so we classify asset as current and non-current. Okay, because in this case, working capital, we deal with current assets. So that's why we define it again this time. So again, when we say current assets, these are assets that are expected to be realized, okay, or converted into cash or consumed or sold during the normal operating cycle of the business or 1 year, whichever is longer. Okay, so this includes normally our current assets includes cash, marketable securities, receivables, and inventory. So you've learned this also in your basic accounting. So what about temporary current assets? Okay, so these are current assets such as cash. Okay, so which means to say that it fluctuates within the firm's operational needs. Okay, of course, cash is the most liquid and most used current assets. Okay, basically, when it comes to firms' operations, that's why it's called as temporary current assets, because they fluctuate with the firm's operational needs. What about permanent current assets? So these are the portion of the current assets required to maintain the firm's daily operations. Okay, so here, normally, it is the minimum level of current assets required if the firm is to continue its operations. So we have a required level of units, okay, of this type of current assets. So what about current liabilities? So here, it requires the use of current assets or incurrence of other current liabilities on their liquidation. So normally, current liabilities are obligations that needs to be settled within the normal course of operation of an entity or 1 year, whichever is longer also. So this is just the opposite of the current assets. Okay, so current liabilities, meaning to say we should pay this with cash normally, or if can be, or if it can be paid with a non-cash asset, then normally what we will use is the current assets, okay, to pay for those current liabilities. So what are current liabilities? So again, you know already this classification. So it will include the trade accounts payable, our unearned revenues, accrued expenses, short-term debt, and the current portion of the long-term obligation. Okay, so here, working capital investment financing policies has 4 types. Okay, so we will discuss it one by one. So the first one is conservative, or what we call relaxed policy. So here, this is when the operations are conducted with too much working capital. So this involves financing almost all over asset investments with long-term capital. So meaning to say here, we have a lot of or too much working capital for financing. Okay, so that's why um, the entity will not have any problem when it comes to investment financing because they have enough assets, okay, to supplement their investment needs. Okay, so here the advantage of this policy is it has lesser risk of uh, illiquidity, meaning to say they are much liquid because they have enough, more than enough assets. Okay. Number two, it will eliminate the firm's exposure to fluctuating loan rates and potential unavailability of short-term credit because here, again, they have enough assets, okay, to supplement for their needs. So, meanwhile, this policy is less profitable because of higher financing costs. So this will be its disadvantage. So again, if it's um, conservative or relaxed, meaning to say it's less risky, so lesser return as well. Okay, so that's the trade-off. Okay, so the second capital investment financing policy is aggressive or restricted policy. So here, operations are conducted on a minimum amount of working capital. So this uses short-term liabilities to finance their operations, not only temporary, but also part of or all of the permanent current assets are required. So here, this is the opposite of the conservative or relaxed policy because in this case, the entity is operating at a minimum amount of working capital. So they can just do anything with it or else they will incur losses. Okay, so the advantage of this policy is it increases the return on equity because they take advantage of the cost different between long-term and short-term debt. So here, again, when talking about investment, this is considered to be high risk. So meaning to say, the entity will also expect higher returns. Okay, so the disadvantage, on the other hand, are um, it expose its exposure to risk arising from low working capital. So anytime that they will exceed their uh, expenses, then they might get low working capital or negative working capital. Okay, another is it puts too much pressure on the firm short term borrowing so that it may have difficulty in satisfying unexpected needs for funds. So, mean to say here, they don't have the um, excess fund to finance unpredictable or unplanned expenses. Okay, so the third policy is matching policy. Okay, so this is also known as self-liquidating policy or hedging policy. So here, what the entity do is that they match the maturity of a financing source with the specific needs. Meaning to say, if or for the short-term assets, they can be financed with short-term liabilities. Or the sources of our short-term assets can be from short-term liabilities. And the long-term assets can be funded also by the long-term financing sources. So we just match, okay, the maturity of financing source to the specific needs. So this is a what we call playing safe, okay, policy because the need for the fund is being matched for the sources. So meaning to say, if that uh, liability is due, so we can pay the current assets available. Or if we need current assets, we source it from current liabilities. And the same also with that of the long-term assets and liabilities. Okay. And the fourth type of policy is the balanced policy. So here, um, this balances the trade-off between risk and profitability or return in a manner consistent with its attitude toward bearing the risk. So normally, um, it it's the same as that. I mean the same. It's like that of the matching policy, but in this case, we're looking into the risk and return. Okay, towards bearing the risk. Okay, so that's for our working capital and investing or investment financing policies.